It's time to do this again. Live from New York City. Good afternoon, good afternoon.
Afternoon.
Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Bloomberg Surveillance. The Fed decides.
The countdown to that Fed decision begins right now, live on Bloomberg TV and radio for our audience worldwide. The Fed rate decision 28 minutes away, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market negative by 1/3% on the S&P 500. TK, that decision just around the corner.
Decision coming around. I guess there's no fun to it. We know what they're going to do, but I'm going to give you a little hindsight back to June 14th. John, you had a 10-year real yield done just before the meeting, 1.61%. We have stormed to a more accommodative 1.51%. And I'd note that the Bloomberg Financial Conditions Index is not going the way Jerome Powell would like it to go.
Does he care?
That's a really good question. Has stopped the show for it. I think we're going to find out in the press conference. Does he care? I like the idea that this is a snooze fest. McKee took a nap. He's ready to go. And the answer is, I think there could be some fireworks in the press conference because nobody knows if he cares. We're going to find out.
That news conference 1 hour away. I've tried to make this really simple. I've asked this question repeatedly over the last couple of weeks. Is it one and done, Lisa, or is there more to come?
That's one of the questions everyone's been parsing through right now. Markets are pricing in less than a 40% chance that there will be another rate hike after this one, maybe September, maybe November. But increasingly, this is considered to be not only the 11th rate hike in this rate hiking cycle, but likely to be the last at a time when financial conditions are essentially easing and people are wondering if housing has bottomed and started to reaccelerate.
And maybe inflation reaccelerates year end. We've heard that from a number of characters over the last couple of days. Max Kettner, HSBC, Francis Donald, Manulife, Andrew Hollenhorst of Citi. Lisa, he's talked about that repeatedly.
And then on the flip side, you have a number of people, including our next guest, who've come out and said, who are we kidding? Inflation is coming down. We are going to go back to where we were before in terms of a slow growth, slow inflation kind of narrative. In that scenario, it's not a head fake. So this is really the key question.
Our next guest itching to get in the conversation. Bob, you've got to wait. Just wait a couple more minutes, Bob.
I knew it.
So exciting, I know. Your equity market on the S&P 500 then, a little bit softer on the S&P. We are negative by 1/3% here. Yields aren't doing much at all going into the decision. We look at this on a 10-year right now, 388.66. And in the FX market, 6 days of weakness for the euro. Just a little bit of a strength today, Lisa. The euro against the dollar, 110.64.
I went on vacation and pretty much it's back where it was when I left, it feels like. Coming up, we do have JPMorgan's Bob Michael, who is itching to get into the conversation and will shortly. iCapital's Anastasia Amoroso and Deutsche Bank's Matt Lazzetti. They'll be taking us up to that 2 p.m. Fed rate decision. Then immediate reaction from KPMG's Diane Swonk, Citi's Andrew Hollenhorst, and Jim Bianco of Bianco Research. And after that news conference, the all-important news conference that really will be where the news is, former New York Fed President Bill Dudley will be joining us, as well as BlackRock's Jeff Rosenberg.
It's great to have Bill Dudley there with a high interest rate call. He's going to really push against the first rate cuts. What I love about this is you want the A-team to show up. And, I mean, our next guest can show up. If you're Liverpool and you're playing
I'm sorry,
in Bavaria, and Salah plays, that's where the A-team for Liverpool shows up for a preseason friendly kind of thing. That's pretty cool.
Is that game the equivalent of Chairman Powell in 60 Minutes?
No, the A-team's going to show up. Seriously, no one's looking for a descent. Is this the day where we see a descent? Interesting.
Let's ask Bob Michael of JPMorgan Asset Management. He joins us right now. Good afternoon, Bob.
Happy to be here.
Good to see you. Do we get dissent in 25 minutes?
We should get a little bit of dissent. I think there's going to be a faction on the FOMC that believes that they've done enough, that you have to wait for the long and variable lags to hit. Remember, the 475 basis point rate hikes only began last June, so now we're a year ahead of only the second one. There are 2 more in the pipeline, and there are going to be others that point to lagging indicators, such as the current level of inflation and the level of unemployment, as their rationale for wanting to do more.
I got a 30-year mortgage out to 7.28%, bank rate 30, the high 7.38%. Can our housing industry or the securitized housing industry that you look at every day at JPMorgan, can they take another 25 basis points?
It's not the next 25 basis points. I think that's okay. What you're already seeing in the housing market is that existing home sales are plummeting. people aren't taking out mortgages below 3% anymore. They're over 7%. That's dramatically changed what they can finance. And by the way, all other forms of borrowing, whether they have an auto loan or they've put stuff on their credit card, that's gone up as well. So they're stretched and they're starting to feel the pain.
They're starting to feel the pain. They were starting to feel the pain a month ago. Maybe 2 months ago. They were supposed to feel the pain much more than they are. Why is it that it's taking so long? And have you pushed out a recession forecast that you still thought was going to be at the end of this year?
We still think that it's going to be at the end of this year. I'd be delighted to push it out into the first quarter, but it's going to be either side of the first year. Frankly, if I go back to last year, knowing what I know now, I would have thought we would have been in recession now, and that's what we spent a lot of time looking at. And we go back to one thing, because the impact of the higher rates, QT, everything was hitting hard back in March when the regional banking system looked on the verge of collapse. And when we looked at the response by the various agencies, we initially likened it to a Bear Stearns moment. In retrospect, that was wrong. It was more TARP moment, because you backstop not only the regional banks, the entire banking system, anyone with deposits of over $250,000. I think that stabilized that. That's injected liquidity into the system. It hasn't changed the end point, which is recession, but the truth is it has pushed it out a little bit.
It also has raised questions about the stickiness of inflation at a time where growth is going to remain strong. I was referring to you earlier. I suspect you'll push back against this idea that we're going to have sticky inflation and the Fed may have to compromise their 2% target. Why?
I think sticky inflation is a load of rubbish. Let's look at CPI. Year over year, it peaked at 9%. You know where it is now? 3%. Look at personal consumption expenditures. I know everyone wants to look at core. It was 5.4, now it's 4.6. It's kind of stuck there. We actually looked at the Federal Reserve statement on longer-term goals and monetary policy strategy. And you know what they have in there? They're targeting 2% on the price index of personal consumption expenditures, not core personal consumption expenditures. So that's their metric. And by the way, that was 7% last year. It's 3.9% year over year currently. It's coming down.
Yeah. I just want to tell you, John, that when you say classics at Pennsylvania, Penn, which is a really, really prestigious degree in liberal arts America, that's when you take load of rubbish 302, and that really gets you set on a case to fixed income research.
Can you imagine being a Southside economist and trying to get a meeting with Bob? And your argument right now is inflation's sticky and things reaccelerate.
It's a load of rubbish.
Yeah,
you know that meeting we've got slotted at JPMorgan Asset Management tomorrow morning? Maybe not. Bob, your other call as well, and Lisa was right to pick up on the recession call. I believe it was rate cuts in September. It was 3%, twos out to 30s on the curve. Has the trade changed, even if the timeline's been pushed out a little bit?
No, the trade hasn't changed. And I would say the one thing we definitely got right was to buy backups in yields on every opportunity. And the high in the 5 and 10 year was back in October. And I know the 2 years gone back up, but it barely broke through the high it set a couple months ago. So overall, you're looking at yields that are pretty stable. So the planet of bond investors doesn't believe the Fed. They believe that there's opportunity in the long end of the market. What has changed for us is a rate cut in September looks unlikely. The Fed is telling us it's not going to happen. Frankly, when we look at the history of the Fed, midway between the last rate hike and recession, they start cutting rates. What they're telling us is to look at the 1981 experience. They're not really telling us, we're interpreting it as that. And if you go to 1981, they hiked rates in May, they cut rates in June, and recession hit in July. And I think because they're terrified about inflation not being close enough to 2%, they're going to keep policy restrictive until they see recession.
Do you think they're more scared of recession now or inflation?
That's a wonderful question for Mike McKee to ask
and Chairman Powell. I think we've all got to understand the answer to that.
I think it's split right now at the Fed. I think it's split.
Interesting. You wonder how that split comes up in about 20 minutes. when we get that decision. Bob Michael's going to stick with us. We've talked a little bit about the Treasury market. Need to talk about credit with him as well. Tom, if you're looking for a slowdown, a downturn in this economy sometime soon, what's the trade on credit at the moment?
The ambiguity right here is amazing. If you look at the Bloomberg Corporate Total Return Index, I mean, it is in-betweeny and has been in-betweeny, which just tells you it's going to cut either way based on a news. So I really didn't participate in that last discussion with Bob.
Were you distracted?
David Hellyer, Giles Turner, Ruth David, Tottenham Hotspur future in disarray.
Yeah.
I just checked out there. I'm sorry. I'll do better after the press conference.
Your transfer window's got a bit messy given what's happening with ownership.
It's just, Harry Kane to Liverpool, it's possible.
Deutsche Bank's Matt Lazzetti is coming up. We won't talk about that with him. iCapital's Anastasia Amoroso alongside him. We'll be talking about the Federal Reserve, that decision, 20 minutes away.
The most likely path is one and done.
One and done.
One and done.
It's one and done.
That's what I would do if I were them.
July 25 basis point hike.
That's in the cards.
Baked in the cake. The done deal. We'll have to see what happens from there.
Really, the only question is what happens after Wednesday.
What kind of signal do they give us for September?
You could get one more hike after this one.
The timing of the next possible rate hike is October-November meeting.
It's going to depend on inflation as well as the growth trajectory.
Powell's really going to have to do a lot of the heavy lifting.
Probably going to be hawkish.
He cannot go dovish.
They'll keep a rate hike on the table.
Keep the optionality to hike further.
We'll get a lot more data between now and then to try to figure this out.
There is a pretty big consensus out
fantastic.
there. One and done. And that one for many people comes in 15 minutes' time. We'll see if they're done. You'll get a clue on that in the news conference in about 45 minutes from now with Chairman Powell. Going into all of that, the price action looks a little something like this on the S&P 500. Equity markets pulling back just a touch by 1/3%. On the Nasdaq, we're down by 0.75%. The attention will shift away from the Fed later to Meta after the close. So look out for numbers from them. Then on to next week, a week tomorrow. You'll get numbers, Tom, from Apple and from Amazon too.
That was great. Two of our interns put that together like at 2 a.m. yesterday.
I think that was my team for the Open, Tom, about 12 hours ago in the middle of the night.
Yeah, it could be like, 2 a.m., whatever.
And that's the actual story.
John, the actual story here is what's the great missed call back to your year-end report that you did, John? The great call here that we missed was the growth of the American economy. Witness Meta, witness Coca-Cola today with a stunning construction. Nobody looked for a first 6 months out of these companies like we're seeing.
Tech absolutely ripping.
Jerome Powell didn't look for it.
Just ripping. Lisa, you remember it. I do too. It was sitting cash 5% good times, and then tech kept going up, and it was sitting cash 5% good times, and then tech kept going up, and it just continued.
It was a valuation story, and suddenly with artificial intelligence, it was a sea change story. I think one of the biggest missed calls is the impact of the stimulus money that hasn't worked its way through the system. To me, that isn't that understood, and the lag effects of that very confusing.
Olivia Blanchard codifies that as the Biden stimulus, and he makes clear it's still there. And, I'll let others tell me what the math is, but that's been one of the great missed calls. Just because the time here is we're 15 minutes away from the ballet with Mike McKee and that important statement. What we want to do with the Fed Decides is be eclectic. We do that with Matthew Lazzetti. He is chief U.S. economist at Deutsche Bank. And Mr. Lazzetti was wonderful at saying this recession will take longer to appear, dead on. Anastasia Amoroso joins us, chief investment strategist at iCapital, who linked what the Fed does into a buoyant stock market. And we continue with Bob Michael of JPMorgan here, looking at yield and the direct ramifications of what the Fed does. Anastasia, let me start with you as well. Does Jerome Powell care, like Alan Greenspan cared, that it is a bull market?
Well, I think he did at some point, Tom. When you've had the bull market in tech and crypto and all of that was kind of finding its way into the inflation narrative. But that narrative has shifted a lot. We're not in the state of inflation emergency anymore. Inflation is not 9%. As Bob was saying before, it's 3%. So I don't think Fed Chair Powell cares quite as much. I think what he does care about is that the Fed funds rate is now over and above the rate of core PCE inflation and is going to continue to be that way. So my take is whether you call it one and done, I call it hike and hold. And that's a perfectly acceptable strategy right now, because if they just hold at 5.5%, I'm being presumptive that they hike today, if they just hold at 5.5%, then core PC inflation is on the declining trajectory. So they will continue to increase that delta. They will continue to increase the real rates into positive territory. And at some point, if they just do nothing and inflation comes down, we will actually be at restrictive real rates. So that's what I think Fed Chair Powell is focused on.
Matt, John earlier was asking about what's the biggest threat for the Federal Reserve, the biggest fight. Is it inflation or is it recession? What are you expecting to hear from them today?
Yeah, I think you've heard from officials that it's coming into greater balance, this risk assessment that they have. And certainly as inflation has shown some broadening out of disinflationary pressures, I think that they view that risk has subsided somewhat. But at this point, I don't think that Chair Powell is willing to say that very clearly the risk has shifted to the growth side. The reality is we've had one softer inflation print. It was a good development. We expect to see more. But I think the Fed has seen head fakes over the past year. They're going to want to see that continue over the coming months. And so at this point, I do still think that they view the risk assessment as too much a little bit on the inflation side of things, particularly given the growth in labor market dynamics that we see and the resilience that's there.
Anastasia, you were talking about keeping the Fed funds rate around 5.5% for a prolonged period of time. Our guest sitting on set is slightly shaking his head, Bob Michele. I know he looks for a potential cut by the end of this year in the face of weakness. How much do you push back against that? Do you think that the Fed could hold rates at about 5.5% well into next year?
Well, I think if the economy is still on solid footing and we're not looking at a recession, that's exactly what the Fed wants to do. They just want to stay there for a prolonged period of time to make sure inflation does come down towards, let's say, 2.5%. Look, I don't think we have a perfect crystal ball on when this recession ultimately is going to materialize. But if I just look at the real rates, and if I look at the forecast of real rates, we're likely to get towards 2% real rate, given the forecast that we have today, at some point in 2024. Wow. And if you compare that 2% real rate that's sometime in 2024, you compare that to the neutral rate that the New York Federal Reserve says it's somewhere around 1, it's likely to decline to 0.9 or 0.7%. At some point in time, we do get into that restrictive territory, but I think that point is still out in 2024.
John, let me frame this. This is a bold statement by Ms. Amoroso. The idea here of a 2% 10-year real yield. Before 07, I extrapolated out a moving average 2.05%, and most experts like Bob Michele are saying to me, not this time. Anastasia's maybe an outlier there.
Bob Michele, jump in, please.
No. I have a tremendous amount of respect for Anastasia. We used to work together. I completely agree with her. We have to listen to what she's saying. She's saying they do one and done, then they're on autopilot, and they let everything else do the work for them. Inflation will be coming down, so the real Fed funds rate will be rising. And they've also got quantitative tightening running in the background. They don't need to do more than today. They actually don't even need to do today. They'll do it.
You're dissenting?
I would be a dissenter if I was on there, but the work is being done for them in the background.
Okay, you're both talking about really important things. So nominal rates stay stable, inflation comes down, so real rates climb. By definition, what does that mean for credit markets, for risk appetite?
It means that the cost of funding is starting to look too high on a real basis relative to their earnings. And some of the fractures we're seeing in the consumer, where deposit balances in the lower quintiles of income are below where they were pre-pandemic, and where credit card borrowing has gone vertical, those things will be very, very painful.
Lucetti screaming at Deutsche Bank wants to cut in here. Matt Lucetti, just let me cut to the chase here within the Lucetti dissent. Are we at a point of instability where you can say we are super restrictive?
No, I don't think that we necessarily are. I think when you look at most measures of asset-based price financial conditions, things have eased materially recently. And I think the Fed will have to take account of that. The big question from our perspective, and I think from the market's perspective, is how much of this bank lending conditions tightening is likely to come through the pipeline. Certainly the Fed Senior Loan Officer Survey has shown this big tightening. We should get additional information on that today. but there's reasons to be somewhat skeptical that that is really going to come through come through and impact the economy. So I'm not sure that it's obvious that at this point, particularly what we're seeing with the labor market and growth dynamics, that we're at a sufficiently restrictive stance.
Where do you think the real yield will go? I mean, we've got this argument with Anastasia about 2% plus real yield. Mr. Michael steps in. I know it's outside your remit, but do you look for an elevated 10-year real yield, or are we at a comfortable point right now?
Look, I think it all depends on how you measure it. So if we're looking at the actual Fed funds rate minus core PC inflation, no doubt that's going to be rising as inflation moderates over the next year. But the market has that priced to a certain extent. It has this disinflationary impulse already being priced, so has real yields relatively elevated as a result of that. And so I'm somewhat skeptical that policy becomes increasingly restrictive as inflation comes down, because that's exactly what the market already has priced.
Anastasia, just to put a bow on where you and Bob agree and disagree, do you see the entire yield curve at 3%? I mean, are you basically saying that the Fed will cut rates at some point, whether it's the end of this year or whether it's early next year, even as they let things chug along? Or are you saying it's going to stay at 5.5% through the remainder or a significant portion of next year?
My best crystal ball trajectory right now is to say that I think they do stay at 5.5%, 5.25% for the rest of the year, because this economy is likely not yet slipping into recession. But as inflation decisively turns the corner, let's say around the end of the year, and maybe we do get some more economic weakness, because, that's right, some of the, cost of housing and cost of financing credit card transactions, for example, it is going up. So I think once we get more of the consumer weakness and inflation has turned the corner, then that's what I think the Fed may start to talk and actually cut interest rates. So I do think in early 2024, we back off of this 5.25%, 5.5% level.
Who needs Twitter when you've got a Bloomberg terminal? Some of the feedback I'm getting right now. Here's one. Bob Michael should be nominated for the Fed. A market participant. Big hole since Kaplan left. Ask Bob if he'd rather have to wear Tom's beige suit or do the press conference for Jay in 35 minutes. That was a good one. This question in here too, Bob. I've let you off on that beige suit all day. In fact, you've worn it a couple of times.
Come on, it's 95 degrees out. I'm
it's not 95 degrees. It's not 95 degrees in here.
Well, it's not in here, but it's like 'tis the season.
I've let it go all week. Come on, I've played
King
nice.
Charles wore one the other day.
And then this one came through as well, just on the market, Bob, and I'd like your reaction to it. At what point do we realise this Fed is hand-holding and emboldens risk-taking? High yield spreads are near the tights of the year. The S&P 500 is something like in and around 5% from all-time highs. What would you say back to that?
I think they've realized that, which is why in the last FOMC meeting, when you look at the summary of economic projections, they threw in the expectation of 2 additional rate hikes, even though they didn't hike rates at that actual meeting. I think it's also why they, like Matt, won't acknowledge the improvement in inflation, because they don't want the capital markets to run wild with that. They're going to maintain a hawkish bias until they get more comfortable that a full range of inflation metrics are within that 2% sphere.
Matt, as we wait for this to drop in about 4 minutes' time, can we work through the statement together? You've got the first paragraph where they characterize growth and inflation. In the third paragraph, they talk about additional policy firming. I'm going through the statement from the last meeting. Matt, can we just start with that first paragraph? How do you think they'll characterize inflation? They say currently in the last meeting, inflation remains elevated. My first question would be, does that change? My second question would be on teeing up additional policy firming in the third paragraph. Would you expect that to change in any way, shape or form?
Yes. So in the first paragraph, I think there's 2 things. They talk about robust jobs gains. There could be an argument that they change that, but I don't think they do at this point. I also don't think they change the inflation story either, description. I think that comes at the coming meetings if we get additional improvement. So by September, I think they can moderate that language. In terms of the forward-looking guidance language that we get, again, I don't expect that to change. Most officials expected another rate hike. I don't think that they want to send a very dovish message. At some point over the coming meetings, I think they focus on this higher for longer messaging, but I don't think they do that today, because I think the market takes that as a signal that they are pausing.
Hey, Matt, this was great. Matt Lazzetti there of Deutsche Bank alongside Anastasia Amoroso. Bob Michael, you're going to stick with us for a little bit. Let's work through that together. You wanted to jump in, I know. Your thoughts?
Yeah, I was interested in, Matt thought they would do anything with the statement on banking remaining stable and resilient. I think that could come out.
Would that mean anything?
It would mean that we don't talk about it, because it's not
talking
there.
about it for the last 2 months. Right?
Yeah, but if it's in there, people are going to wonder, why is it still in there?
You don't think they're going to change anything in that first couple of lines on how they characterize inflation, even with the improvement we've seen over the last couple of months? Do you think 2 more prints down the road, on the 10th in August, on the 13th in September, is that enough information then to make a change at the back end of September?
I think by then, the year-over-year will make it evident that they'll have to acknowledge that inflation has improved.
TK, that's the runway into the September meeting.
The runway into September, and I'd go beyond that to November and December as well. We were talking about this months ago. We're trying to get out 2 and 3 meetings on this. Most important thing I heard in this half hour of discussion is Mr. Michael talking about, hey, folks, forget about the parlor game. You know how much I hate it. There's this balance sheet dynamic as well, allowing for further restriction.
The fact of the matter is, Tom, 3 months down the road, and to Bob's point, we're not even talking about the banking issues in the same way anymore, Bramo. And I remember those days we were talking about credit crunch, hard landing. I think the 2-year had dropped to about 350, went back through 5% in the last month or so.
There's a feeling that we really don't know, and that the Fed's a bit gun shy to call one thing or another and to have conviction. For them to come out and say, yes, inflation has eased substantially, means that they could be setting up for another transitory moment at a time where you've gasoline starting to rear back up and you have housing markets that are continuing to bottom. I mean, this is some of the concerns that people have out there that could really filter into pricing.
I got the CFO of General Motors on it the other day. I believe you were in Norway, Lisa. And he's got a $91,000 pickup truck he's trying to sell. I mean, it's the oddest America right now
it's bizarre.
I've ever seen. I got a $91,000 pickup. The first pickup truck Bob Michael had was what? That C10 you had? It would cost $1,800 and you could see through the floor, right?
We are about 10 seconds away from that Federal Reserve decision, with your equity market shaping up as follows going into that. Equities right now just a little bit softer on the S&P 500. On the Nasdaq, we pull back just a touch. With the decision, here's Mike McKee.
They raised rates. That's about it. Federal funds now at a range of 5.25% to 5.5%. That is the highest in 22 years. In their statement, Fed officials dropped the phrase about pausing to assess the state of the economy, replacing it with, the committee will continue to assess additional information and its implications for monetary policy. Future guidance was identical to June, leaving the door open to another rate move in the future. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the statement repeats, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. The economic assessment is little changed. Activity has been expanding at a moderate pace, perhaps a little faster than the modest pace seen in June. Job gains remain robust, unemployment remains low, and inflation remains elevated. Tighter credit conditions are likely to weigh on economic activity, hiring, and inflation, but the extent of these effects remains uncertain, the statement says, and the committee remains highly attentive to inflation risks. No change to QT. The decision was unanimous. Conclusion, see you in September.
Mike McKee. Get on vacation, seems to be the message from Chairman Powell and the team. Chairman Powell's got to speak in about 28 minutes' time, the news conference coming up. That statement, a bit of a snooze. So let's check out the price action off the back of it. It's one. Are they done? That was your rate hike from the Federal Reserve. Your equity market just a little bit softer still, trying to recover. We're down by about 0.2% on the S&P 500. On the Nasdaq, we're negative by 0.4%. The fate of the Nasdaq, of course, through the next week in the hands of earnings from Meta, Apple, Amazon, over the next 7 or 8 days or so. Outside of that, into the bond market, your 2-year yield coming in just a touch, just a little bit, fading after that decision. Now just about unchanged on the day, with the 2-year at 4.88. And if you turn to the FX market off the back of that, with yields just about unchanged, the dollar showing just a touch of weakness against the euro in response to this decision. Euro dollar at about 110.74. TK, a rate hike from the Federal Reserve. It's about the what's next. It always was.
22 years out, you go back, I believe the math is, to 2001. Joining us, Diane Swonk, Chief Economist, KPMG. Bob Michael continuing with us with JPMorgan. Diane, I'm going to just argue this, and I did this 2 days ago in a YouTube short showing the NASDAQ 100 decline of March of 2001. Things unraveled the last time we were at interest rates of this level. Do we have an analog here to the collapse of the market in March of 2001? Can a Fed policy affect a present stock market collapse?
Well, it certainly can if they go far enough, and so far it's been remarkably resilient. I would argue that we're also seeing this against the backdrop of what looks to be a bubble emerging in Gen AI, which is a little reminiscent of 2001, but not quite there. But I think that's important to remember as well. I think the larger issue for the Fed at this point in time is that financial conditions are fighting them a bit. And even though they've got additional quantitative tightening, they've continued that. That's why they're still going forward. And I would argue one step further in that the good news we've gotten on inflation recently further emboldens the Fed to actually get to that 2% target. There was sort of this sense among people around the Fed and some within the Fed that, they'll get close to 2% and then feel they've kind of done enough because of what they thought would be the pain needed and the trade-off needed to get to 2%. I think they're going to feel a little more emboldened now to actually get there, which means tighter policy for longer than many expect. And I think that's something that we've sort of not really come to terms with yet, is sort of the unspoken side of what the Fed had been saying, is that people were expecting the Fed to kind of stop short of 2%.
It seems like this is Operation Don't Make Waves. It seems like this was not a Fed looking to jawbone the markets into anything. This was the Fed trying to back into the shrubs and disappear. Diane, would you agree with that characterization? Is that sort of the goal for Fed Chair Jay Powell as he takes the helm of that press conference meeting in about 25 minutes?
Well, certainly they didn't want to change their message. Whether or not that's fading into the background, I mean, given the easing in financial conditions that we've seen, particularly in recent months and in recent weeks, that's something the Fed that has to sort of be a bit concerning to the Fed. What they're worried about is not what the inflation data is going to be by September. They're worried about the end of the year seeing a potential acceleration, and that it's a bumpy sort of ride down to 2%, and that we go in fits and starts, and some of those mean an acceleration back up again. And that's what they're worried about. And anything that we see that's too much of an easing in financial markets, that's going to feed into that. Remember, bank credit is only about a third of all credit in the U.S. economy, although there are a lot of spillover effects, even in shadow banking industry for consumers, from the tightening that we're seeing in the banking sector.
If you are just tuning in, welcome to the program. Fantastic lineup going into the news conference with Chairman Powell in about 25 minutes' time. We're talking to Diane Swonk and Bob Michele as well. Bob Michele of JPMorgan Asset Management are with us around the table in a studio. Bob, just initially, your reaction to that decision 5 minutes ago.
I think it was exactly on expectations. They wanted to get the 25 basis points done. They didn't want to convey accidentally anything dovish. They reinforced that additional firming may be necessary, that inflation's elevated. They're trying to do exactly what Diane talked about, not give financial conditions a chance to ease further.
But they are. The Bloomberg Financial Conditions Index, I believe it's 11 ratios. Michael Rosenberg invented it with his team. It still shows an accommodation that screams, I'm thinking of Hollenhorst, it's Citigroup, and others go the other way, including Ellen. The idea, where's the ammo for the next meeting to raise 25 beeps? What's the data that will drive that?
I think they would need to see inflation start to tick up. Not stay stable or continue to decline like it's doing. That's the only reason I would think they would hike at the next meeting. I think by the time we get to the September meeting, inflation will have improved to a degree, and I think you'll see more labor market slack that they'll sit there and go, we've done plenty.
Diane, what's your concern for the press conference, given the fact that Jay Powell has a penchant for being a bit more revealing than he'd like, eliciting the reaction that perhaps they were avoiding in the statement?
Well, I do think that they want, I think Jay Powell is going to go into this press conference being a little more defensive in terms of not wanting to ease financial conditions more and not wanting to have a confirmation bias on that. So I think he's going to be much more astute to that in this particular meeting. I do think it's hard for them to raise rates in September. However, we know that in October, the medical component of the CPI at least reverses after 25% decline in insurance from a year ago in the June number on CPI. That reverses both month to month and on a underlying level year over year. in October. And once you get to November, you could see a bump up in inflation again that does worry the Fed more, along with some other issues that we've got coming in the pipeline with supply chain disruptions, everything from what's going to happen with grain prices to the fact that energy prices have come back up. All of those things coming back in with persistent demand. Further complicating September are strikes. We've got the UAW maybe on strike by September. We have avoided the Teamster strike, but the SAG strike has a lot of spillover effects, which has a potential of giving us a very strange August employment number that could even move to zero or into the red just because of the fallout effects on the industry. And I think those things are going to make it very difficult for the Fed to move in September. But September, they lay out their forecast again. And we'll get the view from there in terms of higher for longer, and do they expect one more hike? I think they're going to want to keep that in their pocket to be able to do it if they need to later in the year.
Bob, Diane just laid out basically sticky inflation or stickier inflation, things that come back, whether it's the labor strikes or whether it's some of these year-over-year comps as supply chain issues rear their heads again, as well as a whole host of other issues, including gasoline. We mentioned that earlier, surging. What's your pushback to that, to all of these base effects that start to lose some of their luster?
That's not what I heard her say. What I heard her say, it's business as usual. Nothing's quite black and white. Everything's mixed. We look at a lot of things in here, and what you're betting on is if wages still remain elevated, that companies will be able to pass along those price increases to consumers. We're seeing that they're not able to do that to the degree they were able to. Consumers are pushing back, they're going down brand. We've also looked at wages quite a bit, and we looked at a lot of them. We looked at unit labor costs, we looked at the employment cost index, we looked at average hourly earnings. We took 6 of them, we weighted them, and we came up with the peak in wage gains was last year. It was just about 6%. Today, it's just under 4%. 3.5% wage gains is what the Fed and Chair Powell have indicated to us is fairly neutral. They're not that far off. It's going in that direction. Prices may go up for certain things, but what we're seeing from the consumer is they'll just cut back spending somewhere else.
Let's talk about this cumulative tightening and pull out a quote from the statement from the Federal Reserve, which on the surface of things sounds pretty boring. It reads like follows. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags, and that's the key word I want to fix in on, the lags with which monetary policy affects economic activity and inflation. Neil Dutta, one of my favourites out there over at Renmax, saying this: the Fed is wedded to the long and variable lags hypothesis. After 18 months, we have seen home prices accelerate, stock prices accelerate, auto sales accelerate, and layoffs sink. Long and variable lags is a concept that might be outliving its usefulness. Diane Swonk, I know you've got to run, but I'd love your input on this debate. What are your thoughts on that?
You know, I think actually the lags are much longer than the Fed actually thought. The Fed really had gone into this tightening cycle thinking that there was almost a real-time reaction function, that the lags had shortened, and they were wrong. And in fact, what we saw is this mortgage winter where people won't move out of selling their 3% mortgage home or listing it, or they've already paid off their mortgage and they can't afford to go into a higher rate. The transmission mechanism on monetary policy was blunted. That doesn't mean it doesn't eventually hit, but it has elongated the lags. And I think the Fed is worried about that the lags are still out there. And that's, again, why you don't move in September, because you could see more headwinds, as we talked about earlier, in terms of, credit market tightening, what consumers face, rejection rates on everything from consumer credit cards, mortgage rates, and mortgages and vehicle loans have all soared. Now, they've soared over a period since 2013 on the vehicle side to record high levels, but we don't know historically if that's really where we're at. But I do think it is important to note that there is some things the Fed is going to be watching for to see how much does this slow down the economy going forward.
Diane Swonk of KPMG. Diane, thank you, as always. Wonderful to get you to weigh in on a Fed decision which came out about 12 or 13 minutes ago. 25 basis point rate hike. Bob, you were listening to that conversation. Can't you make the argument just as easily as saying policy lags are really long by also just saying they're also really short?
They're long and variable is what they are.
Are they?
They are.
Okay.
I'm going to quote the Fed. And also, when I hear the conversation about supplies and pricing, we're also looking at Greenspan's favorite indicator, vendor deliveries. And that's shown the greatest improvement going way back before the financial crisis. So the thought that there was pricing power because your goods were stuck on a container ship in the Pacific, forget about it. They're here. They're actually piled up in warehouses and on shelves. And when you look at inventory to sales, they're off the charts high. The only way to clear them in an environment where the consumer is clearly cutting back, going down brand, and is stretched, is to cut prices.
That's good. Can you say the same thing about services?
We'll see. I think so.
Isn't that the big question, though? Forget the goods argument.
I think so. I think just the cost to finance travel, leisure, all of those things on your credit card, which is what is happening. That's why revolving credit usage has gone up so much. It becomes punitive after a while. It's just not sustainable.
Bob Michele at JPMorgan Asset Management alongside us on Fed decision day, the 25 basis point hike behind us. No big changes to the statement. The news conference with Chairman Powell begins in about 16 minutes' time. Joining us now is Citi's Andrew Hollenhorst alongside Jim Bianco of Bianco Research. Andrew, you've had the benefit of extra time to go through this. Your take on what we learned 15 minutes ago.
You know, it's interesting. It's interesting because of what did not change. This seems to have been very carefully put together so as not to send a dovish message like Diane was talking about. Really notable, I think, that the Fed could have taken the opportunity to say headline inflation has come down, core measures are still elevated, but they left that statement unchanged. It still just says inflation is elevated. On the growth side, what was modest growth is now characterized as moderate growth. So just the tiniest inkling of a little bit of hawkishness that's creeping into this statement, at least relative to expectations.
Some of that little bit of hawkishness on the street, folks, came from Jim Bianco, who joins us right now in Chicago. Jim Bianco, you know, I look at where you are in the bombshell you had a number of weeks ago of saying maybe we're a little more sticky than we actually think we are. Where is Jerome Powell's presumed R-starred path at this press conference? The zeitgeist is he's down to 2%. Things are normal. We're going to get back to normal. I'm going to suggest you disagree with that.
Yeah, I do. I do think that we might be on a year-over-year basis looking at the lows of the year in inflation, in June, and that we're going to see there's going to be a big base effect for the rest of the summer, and it's going to start to drift towards 4, and we'll be lucky to be back even close to 3 by the end of the year. And that will bring up the big question is the long run, rate of inflation, is it 2 or is it 2.5 or 3? And remember, the Fed has already told us that neutral rate is 50 basis points above the long run inflation rate. So if it's 2.5, then neutral is 3. And if the yield curve goes back to some normal level, which is around 150 basis points, you're talking about a fair value for the 10-year at 4.5. And we're at 390 right now. So we're a little bit low. And it all comes back to this whole argument about inflation and where's inflation going to go. And I've been arguing, the big fancy word, that this is a post-pandemic economy. That means that all the models on how inflation are going to work haven't worked since 2020. Right. And we have to write some new models on how it's going to work. Work from home being one big thing about how major that the labor market has changed, and a lot of other things too, like with the supply chain. And I think we're going to wind up with stickier inflation.
And Lisa, this is critical because this is what our booking team, we've got the morning crew and the afternoon crew that do it 24/7 for us. And to see the setup here of Hollenhorst, Michael, and Bianco and the collegial disagreements they have is the heart of the matter and how it rolls back over into whatever we're going to make or lose in the stock market.
Which is the reason why I'm kind of shocked that this was an 11-0 decision. There was no
I
dissent.
agree with that strongly.
Given the fact that there are such divergent opinions.
This delusion of unanimity is the British do this better than we do.
Well, I guess that's what I would ask you, Andrew. Do you think that it undermines the Fed to have unanimity at a time where there clearly is not unanimity in markets or on the Fed?
Look, I share with you the surprise that we would have no differences of opinion at this point. I think Powell has been somewhat masterful in terms of getting these decisions to be unanimous. But we saw that sometimes coming at the cost of clarity. I think that's what happened in June, where we had this strange decision not to raise rates, but to signal that it would be appropriate to raise rates another 50 basis points. So as you try to keep that committee together and get unanimity, it's a little bit troubling in terms of getting clarity in terms of the communication.
Bob, your take on this in terms of whether it's helpful or harmful to have unanimity at a junction that is clearly so fraught with disagreement on the street and at the Fed?
I don't think the unanimity is the accurate portrayal of what actually occurred in the meeting. And I'm dying for Bullard to go into public life into private life so that we can ask him these questions. I think what they did is they locked arms. As Diane's pointed out many times, they are concerned about financial conditions easing. This is another way to try to stop that from happening.
I look, Bob, at this. I can just see you with a speech with Bullard down at Purdue. What a debate that would be right now as he moves from the St. Louis Fed to Purdue. That goes to the dots and the dispersion. This was a Fed. Let's speak for those that don't keep score on this, like I don't keep score on this. This is a dot-free meeting. How important is the setup to the next dispersion, the next theater of dots? Or are we beyond that?
We're living in an AI world now. What are we doing? Not doing dots and summary of economic projections at every meeting. Let's do it and indicate more about what the Fed is thinking. I think
you want more transparency.
If you're going to do it,
want to know, and I think particularly, not usually, but after the last meeting, we've all talked about what were they doing? They didn't hike in June, but they indicated another 50.
That was odd.
If I were Mike McKee, I would ask Chair Powell, what about the dots in the summary of economic projections from the last meeting? Do you still stand by those, or would have anything changed?
Well, it's unclear which dot belongs to which policymaker. Bostic might have been one of those that would dissent today. Bostic doesn't have a vote on the committee at the moment. Bullard doesn't have a vote on the committee either. The Board of Governors, that would be where my issue is, because the Board of Governors, even if they believe that they shouldn't be doing one thing, they all vote as a committee, as one. So I just wonder, Andrew, how much we should read into the lack of dissent at today's meeting, and that maybe the September one is the one where it gets a little bit more fiery.
Yeah, I think it's definitely the case that there's a lot more going on behind the scenes here in terms of some disagreement. We saw some of that in the minutes to the June meeting. So there are real differences of opinion. And I think, like Diane, like the others were talking about earlier, this could really get interesting in September. In September, they'll have to make a decision. First, whether to hike rates. I think they probably won't because the inflation data has been softer. But then what do you do with those dots? Are you still showing that you're going to hike again this year? That would imply a hike in November. Are you then indicating that that's the last hike of the cycle if we see inflation picking up further? And I think that the risks are that it will as we get towards the end of the year. So it gets really tricky as they get to that September meeting. And then December, dots again. Are you showing no further hikes? Are you showing cuts? What do financial conditions do with that?
Jim, come back in here because you were talking about how models are broken and they're not really forecasting inflation in any kind of accurate way. What is the compass for the Fed? Do we have a clear sense of what data dependency means in the post-pandemic era, where suddenly the data is not a reliable forward-looking indicator?
To be frank, no, we don't. And that has been one of the bigger problems, is that in a data-dependent world, what the Fed is trying to do is they're trying to divorce themselves from any theory that of how the economy and inflation is supposed to work, and they're supposed to react to the data. And then we get what we've had in the last 2 months. They paused in June. We got a big miss in the inflation report. Year over year went from 4 to 3, and then they hiked. And so I'm not exactly sure why they paused and why they hiked and what they're going to do next, based on their recent action, which is why I would underscore what Bob said, that, Mike McKee's got to ask, what are you doing? And what is driving these decisions?
Right.
You pause, and then we get good inflation data, and then you hike. So there's a big confusion going on out there right now. And it's all part of the modeling that we've seen in the market. It's been very difficult to figure it out.
I want to set up one question here and give it back to John to get to the press conference in 6 minutes. I want to go to Bianco and then Hollenhorst, and then Michael here. I want to know your 12-month forward real GDP as you also violently disagree on inflation. Jim Bianco, 12 months forward real GDP. What's the statistic?
About 1.25 or so.
Okay. Hollenhorst?
I think we will have seen a decline. I think we'll have seen a recession by then, so we'll be sub 1% GDP.
Ferroli, Casman, what do they say? We'll fold it in.
I think we'll have passed through -1.5% to -2% real GDP.
This is not, John, in the American zeitgeist right now. The combination of those three opinions wrapped around their different inflation outlooks, this is removed from Meta, removed from Google.
We can't let them go just yet, Tom. There's still 7 minutes before the...
No, I know, but you're going to, I got to get back to Tottenham. I'm just trying to see what the future is.
You just want me to speak for 7 minutes now.
Yeah,
until the
I
news
got to
conference.
read about Tottenham.
As you were talking about that, I was noticing Mercedes-Benz raised their full-year guidance. I'm just sitting there thinking, hike again, 50 basis points. Mercedes still getting it done.
Coca-Cola too.
Yeah, Jim, let's talk about that, though. In all seriousness, who's paying these high rates? Where are they biting?
That's a good question. I think that they're biting at the business level, that they're wanting up to pay higher rates. They're definitely biting at the residential real estate level. You've seen a wholesale change in the way that the residential real estate market, existing homes don't move, and we've been trying to fill the gap with new construction because we've got a multi-year low in the volume of existing homes. So they've been biting there as well. Where they're not biting, by the way, seems to be in the cost of capital in the stock market. That doesn't seem to be bothered by it at all. So it's unclear as to where it is. And that might be leading to an idea that maybe all we've done with a 500 basis point plus rise in rates is just pretty much track neutral. And we're not really that restrictive, which is why we're not seeing these high rates hurt the economy as much as we thought.
Bob Michael, what would you say back to that?
I think it's biting in a lot of places. I think it is biting in the corporate world. You look at bank loans, defaults are rising pretty sharply. You look at the private credit markets, talk to people in there are real tremors there about what's happening in terms of exchanges and extensions. You start looking at, we didn't talk about central business district office space. That's still out there, unoccupied. That's owned in places. We saw that in Goldman's earnings. That has yet to be reconciled. So it's biting hard. We talked a lot about the consumer. They are really struggling.
Would you like to talk more about Goldman earnings? No, take a pass on that. Thought you might. Andrew Hollenhorst. Bob went there.
Hollenhorst.
Bob went there. Come on. Bob went there. I said Goldman. No. Andrew, I think we need to spend a bit more time talking about this. Just how much of the disinflation that we've seen recently is a consequence of the tightening cycle of the last year? How do you know? How do you identify that kind of thing?
Well, I think that's partly why the Fed's in a little bit of a difficult position here, because they've taken some credit for some disinflation that they did not have a lot to do with, which is the decline in energy prices, which is the decline in food prices. And then we're seeing, as we head into this meeting, we're having very large daily increases in gasoline prices. So it's certainly not going to feel to a lot of people like inflation really has been conquered. Now, somewhere where they do have a direct effect is on the housing sector, shelter inflation. And again, though, I would raise a caution there that we're kind of in this narrative that shelter prices are slowing, and they are. There's a lag that's introduced into the way that the data are put together. So those shelter prices will slow in official inflation statistics, but look at the reading from Case-Shiller. Look at what we're seeing in the real-time housing price data. Those house prices are rising quickly now. So there's some real upside risk to inflation, which would kind of go back to Jim's point that maybe 5%, 5.5% policy rates aren't the amount of restraint on the housing sector, at least that we thought it was going to be.
So I promise you this really is the final round of questions for all three of you, with the news conference about 3 or 4 minutes away. We need to get your questions for Chairman Powell. We touched on it briefly. You don't get to repeat that twice. Jim, what would you ask the chairman today in about 4 minutes?
Basically, what has been driving the decision-making to pause and to hike? I kind of said that earlier, but it does drive at the confusion as to what is really on top of mind for the Federal Reserve.
Andrew, what about you?
I would ask about the rebound in the housing sector, prices, growth, upside risk to both.
Well, Michael?
I'd ask what range of inflation and growth metrics are they using, and what levels would they look at for them to, one, pause permanently, and secondly, cut rates?
What would they tolerate? I've heard that from PIMCO, that maybe 2 point something. They'd be happy with that. They'd be okay with that. Does that resonate with you, 2 point something?
On headline, for sure, as long as the trend is headed down.
Jim Bianco, Andrew Hollenhorst, to the two of you, thank you. Moments away from that news conference with Chairman Powell, following a 25 basis point hike from the Fed chairman. Bramo, it's almost question time, and you can hear from the panel in the last 20 minutes, bit of confusion over why they paused last time around, why they hiked this time around, if they are truly data dependent.
What data they're looking at, what their model is right now to gauge out inflation going forward, what their threshold is, as Bob was saying, to hike or to cut. We don't have a sense of any of these things. The model is, come on, we're looking at it. And there's super core and
Everyone was high-fiving the Fed a few weeks ago when we got that inflation data.
Yeah.
It was like victory lap time, Bob. Victory lap. People talking about a victory lap for the chairman of the Federal Reserve.
If you step back and look at growth and inflationary pressures, they are moderating. They should just put it in park and come back in January.
And do a victory lap?
I don't know about the victory lap.
That feels too premature to me. That really does. Yeah. One print, TK, and start celebrating.
This has been a fascinating discussion. Thank you so much to our team for putting together this just brilliant conversation, collegial disagreement. The common theme here from Marquette academics to UCLA academics to University of Pennsylvania academics is this is a press conference without theory. And I know I'm going to get pushback on that from Mike McKee and others, but off the pandemic, they're flying blind. And Bob, I would say they're as data dependent as we've ever seen.
Yeah, I think so.
Ever.
Well, look, I think that you are right that this is perhaps a theory-free Federal Reserve that's still trying to hew to some of the theories that underpinned their role in all of this. I would argue one of the biggest questions, John, is whether tightening has the same effect on an economy that is not showing signs of slowing down. To your point, the lag, the variable, long and variable lag.
A super long.
Super long,
really short.
but also variable.
I've got
so
no
then
idea.
how do we then talk about the efficacy of what they're doing?
Lisa, they don't know, which is why they're in the risk management business, and they've got to work out what is the biggest risk. Cutting too soon or holding too long. And that's really, really difficult to do. I think it's easier to say we need to cut because we've gone too far. It's harder to say these disinflationary trends are on their way back towards taking us to a sustainable path to 2%. That's a much, much bigger call.
I don't know the answer to what's the biggest fear. Inflation or recession. We don't know. And what you hear is from everyone on Wall Street, a different answer.
Let's go through the scores going into this news conference with Chairman Powell, who just enters the room. Your equity market negative 0.2% on the S&P 500, following a 25 basis point interest hike from the Federal Reserve. Here's the chairman of the Fed.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate 1/4 percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the past 3 months, job gains averaged 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 3.8%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In June, the 12-month change in the Consumer Price Index, or CPI, came in at 3.0%, and the change in the core CPI was 4.8%. Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning to inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 5.25% to 5.5%. We are also continuing the process of significantly reducing our securities holdings. With today's action, we've raised our policy rate by 5.25 percentage points since early last year. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of our ongoing monetary restraint to be realized, especially on inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting, based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Mr. Chairman, thank you. You have, I think, a couple times in your opening remarks talked about this language in determining the extent of additional policy firming that may be appropriate. Should we take that to mean that additional hikes are likely on the way? And should we also believe that all future meetings, say September and November, are live, or are you in a every other meeting mode? Thank you.
So we haven't made a decision to go to every other meeting. It's not something we've looked at. We're going to be going meeting by meeting, and as we go into each meeting, we're going to be asking ourselves the same question. So we haven't made any decisions about any future meetings, including the pace at which we'd consider hiking. But we're going to be assessing the need for further tightening that may be appropriate. You read the language, to return inflation to 2% over time. I would say that the intermeeting data came in broadly in line with expectations. Economic activity remained resilient. Job creation remained strong while cooling a bit, and the June CPI report actually came in a bit better than expectations for a change. And the June CPI report, of course, was welcome, but it's only one report, 1 month's data. We hope that inflation will follow a lower path it will be consistent with the CPI reading, but we don't know that, and we're just going to need to see more data. So what are we going to be looking at? Really, it will be the whole broader picture, and starting with we're looking for moderate growth, right? We're looking for supply and demand through the economy coming into better balance, including in particular in the labor market. We'll be looking at inflation. We'll be asking ourselves, does this whole collection of data, do we assess it as suggesting that we need to raise rates further? And if we make that conclusion, then we will go ahead and raise rates. So that's how we're thinking about the next meeting, and how we're thinking about meetings going forward potentially. But we're now mainly thinking about the next meeting. I will also say, since we're talking about it, between now and the September meeting, we get 2 more job reports, 2 more CPI reports. I think we have an ECI report coming later this week, which is Employment Compensation Index, and lots of data on economic activity. All of that information is going to inform our decision as we go into that meeting. I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting. And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. Monetary policy, we believe, is restrictive and is putting downward pressure on economic activity and inflation.
If I could just briefly follow up on something you said there. You said the data in the intermediate period, it broadly came in line with expectations. Does that mean there's unlikely to have been a change in the overwhelming outlook of the committee that 2 more hikes are necessary?
I'm just going to go back to what I said. That's the question. We have 8 weeks now until the September meeting, and all that data that I recited, we're going to be looking at all of that and making that assessment then. And it really, we did have the one good reading, and of course we welcome that, but it's just one reading, as everybody knows. And we've seen this before in the data. Many forecasts call for rates for inflation to remain low, but we just don't know that until we see the data. So we'll be focusing on that.
Thank you. Thanks for taking our questions, Chair Powell. Obviously, you upgraded the language around growth in the statement today. We've seen the Barbie movie numbers. We've seen everyone going to Taylor Swift concerts this summer. It seems like the American consumer is in pretty good shape. And it does seem like growth is sort of picking back up a little bit, or at least doing well. And I wonder, from your perspective, if that continues, if we see growth not just stabilizing, but performing well this summer, is that a problem because it's inflationary, or is it good news because it suggests that a soft landing is more likely? Just how are you thinking about that sort of trajectory?
Yeah, so I would say it this way. The overall resilience of the economy, the fact that we've been able to achieve disinflation so far without any meaningful negative impact on the labor market, the strength of the economy, overall, that's a good thing. It's good to see that, of course. It's also, you see consumer confidence coming up and things like that. That will support activity going forward. But you're right, though. At the margin, stronger growth could lead over time to higher inflation, and that would require an appropriate response from monetary policy. So we'll be watching that carefully and seeing how it evolves over time.
Thanks, Chair Powell. Neil Irwin from Axios. So as you referenced earlier, in the intermeeting period, soft CPI, jobs reports, still strong but moderating, JOLTS looks good. So if you're data dependent, why not pause again? Why not stay on hold? Why not take another meeting off when the data was at least cutting in the direction you want to see?
So if you go back to what we're trying to do here, we're trying to achieve a stance of policy that's sufficiently restrictive to bring inflation down to 2%. At the last meeting, we wrote down our individual estimates of what that would take, and the median of that was an additional 2 rate hikes. So I would say we looked at the intermeeting data, and as I mentioned, broadly consistent, not perfectly consistent, but broadly consistent with expectations. And as a result, we went ahead and took another step. And that's a labor market that continues to be strong, but gradually slowing. I mentioned that the inflation report was actually a little better than expected, but we're going to be careful about taking too much signal from a single reading. And growth came in stronger than expected. So that's how we look at it, and so we did take that step today.
Nick Timmeros of the Wall Street Journal. Chair Powell, markets widely believe the median FOMC participants' inflation forecast from June for the fourth quarter of this year will be too high, given autos and shelter, and that by September that may warrant a downward revision in the inflation forecast of 20 to 30 basis points. Would that type of inflation progress be enough to hold rates steady from here, or do you need to see below-trend growth and decelerating labor income growth to be convinced that you've done enough?
So it's hard to pick the pieces apart and say, how much of this and how much of that. We'll be looking at everything. And, of course, we'll be looking to see whether the signal from June CPI is replicated or the opposite of replicated, or whether it's somewhere in the middle. We'll be looking at the growth data. We'll be looking at the labor market data very closely, of course, and making an overall judgment about that. It's the totality of the data, I think, but with a particular focus on making progress on inflation.
If I could follow up, last month you said there were benefits to moderating the pace of increases because it would give you more information to make decisions. Would another CPI report like the one we just had in June allow you to at least maintain that slower pace and defer until the fall any decision on whether you need that second rate hike?
So I'm just going to tell you again what we're going to do in September. We're going to look at 2 additional job reports, 2 additional CPI reports, lots of activity data. And that's what we're going to look at, and we're going to make that decision then. And that decision could mean another hike in September, or it could mean that we decide to maintain at that level. And again, the question we're going to be asking ourselves is the overall signal one that we need to do more, that we need to tighten further? And if we get that signal whenever we get it, then, and that's the collective judgment of the committee, then we will move ahead. If we don't, then we'll have the option of maintaining policy at that level. But it's really dependent so much on the data, and we just don't have it yet.
Hi, Chris Rugaber at Associated Press. So consumer confidence in the economy is rising, likely in large part because of the declines in headline inflation. You also see wages are also rising faster than prices now after trailing them for a long time. How much are Americans truly harmed by inflation at its current level, headline level of 3%? And with that in mind, when do you put some weight back on the employment side of the dual mandate?
So I guess I'd say it this way. First, it is a good thing that headline inflation has come down so much, because that's really what the public experiences. And I would say that having headline inflation move down that much almost creates it will strengthen the broad sense that the public has that inflation is coming down, which will in turn, we hope, help inflation continue to move down. So you are really, sorry, what your question was?
Well, I mean, you've talked for many press conferences now about the harm created by inflation, how hard it is for people. So how much of that are we still seeing with inflation now down at 3?
So I guess I would put it this way. I'd say it this way. It's really a question of how do you balance the 2 risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not, but as our stances become more restrictive and inflation moderates, we do increasingly face that risk. But, we need to see that inflation is durably down that far. As you know, we think, and most economists think, that core inflation is actually a better signal of where headline inflation is going, because headline inflation is affected greatly by volatile energy and food prices. So we would want core inflation to be coming down, because that's what we think core is signaling where headline is going to go in the future. And core inflation is still pretty elevated. There's reason to think it can come down now, but it's still quite elevated. And so we think we need to stay on task, and we think we're going to need to certainly hold policy at a restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
Well, and then if inflation were to, just a quick follow, if it stays at 3 or drops even a little bit more, I mean, how much of an increase in unemployment do you think is acceptable to get that last bit of inflation? People are talking about the potential difficulty of the so-called last mile of inflation. So But how much unemployment do you think is justified to get down that last?
So it is a very positive thing that actually the unemployment rate is the same as it was when we lifted off in March of 22 at 3.6%. So that's a real blessing, and that we've been able to achieve some disinflation. And we don't seek to, it's not that we're aiming to raise unemployment, but I would just say the historical record, we have to be honest about the historical record, which does suggest that when central banks go in and slow the economy to bring down inflation, the result tends to be some softening in labor market conditions. And so that is still the likely outcome here. And we hope that that's as little as possible. We have to be honest that is the likely outcome. The worst outcome for everyone, of course, would be not to deal with inflation now, not get it done. Whatever the short-term social costs of getting inflation under control, the longer-term social costs of failing to do so are greater, and that the historical record is very, very clear on that. If you go through a period where inflation expectations are not anchored, inflation is volatile, it interferes with people's lives and with economic activity, and that's the thing we really need to avoid and will avoid.
At this point, you say the policy is restrictive, but all year long we have seen growth surprise to the upside, unemployment to the downside, and inflation lately to the downside. So I'm wondering, by definition, should you be restrictive enough right now under these conditions? Do you think you might need to do more? Because I'm curious about what you see as inflation dynamics now. Is the economy still moving in a direction where it creates more inflation? People talk about base effects and higher energy costs, and now we have some large labor settlements. Or is the economy disinflating, and you're able to go back to the old Fed policy of opportunistic disinflation?
So I'll just say, again, the broader picture of what we want to see is we want to see easing of supply constraints and normalization of pandemic-related distortions to demand and supply. We want to see economic growth running at moderate or modest levels to help ease inflationary pressures. We want to see continued restoration of supply and demand balance, particularly in the labor market, and all of that should lead to declining inflationary pressures. Now, what we see is those pieces of the puzzle coming together, and we're seeing evidence of those things now. But I would say that what our eyes are telling us is that policy has not been restrictive enough for long enough to have its full desired effects. So we intend, again, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate. And we think the process, still probably has a long way to go.
Well, do you think under current conditions you are restrictive enough unless something changes?
Well, I think we think today's rate hike was appropriate, and I think we're going to be looking at the incoming data to inform our decision at the next meeting about is the incoming data telling us that we need to do more, and if it does tell us that collectively, if that's our view, then we will do more.
Thank you. Colby Smith with the Financial Times. If September is in fact a live meeting, how does that square with the need for a more gradual tightening pace that you spoke of last month in explaining the rationale for holding the funds rate steady at the June meeting?
So a more gradual pace doesn't go immediately to every other meeting. It could be 2 out of 3 meetings, right? It just means if you're slowing down. The point really was to slow down the decision cycle as we get closer and closer to, we think, our destination. And I wouldn't want to go automatically to every other meeting because I just don't think I think it's not an environment where we want to provide a lot of forward guidance. There's a lot of uncertainty out there. We just want to keep moving at what we think is the right pace. And I do think it makes all the sense in the world to slow down as we now make these finally judged decisions. And so that's what we did. And so I think it's possible, I mentioned before, it's possible that we would move at consecutive meetings. We're not taking that off the table, or we might not. It's really going to depend on what the data tell us. That's the best we can do.
So we shouldn't assume that every other meeting is the lowest tightening frequency, let's say. It could be, longer intervals in between as well.
I think we're going to look. I think we're going to make a decision about the next meeting, and then we're going to make a decision about the one after that, and I think it'll sort itself out.
Thanks. Howard Schneider with Reuters. Among your colleagues, there have been people who've said they feel that very little transmission has taken place so far from monetary policy into the economy, and there are those who feel, they say, it's happened very fast this time and it's kind of up to date. Where are you on that continuum?
So there's a long-running debate about the lags between changes in financial conditions and the response to those changes from economic activity and inflation, right? So we know that in the modern era, financial conditions move in anticipation of our decisions, and that has clearly been the case in this cycle. So in a sense, the clock starts earlier than it used to, but that doesn't necessarily change the process from that point on, and it's not clear that it has. I'll tell you what we know and then what we don't know. We know that financial conditions affect economic activity and inflation with a lag that can be long and variable, or lags, plural, that can be long and variable. A lot of uncertainty around the length of the lags, and by the way, that's just one component of the broader uncertainty that we face. So I'll tell you how I think about this. The first thing to say is we're determined to bring inflation down to 2% over time, and we will use our tools to do that. No one should doubt that. I would look at it this way, though. The real federal funds rate is now in meaningfully positive territory. If you take the nominal federal funds rate, subtract a mainstream estimate of near-term inflation expectations, you get a real federal funds rate that is well above most estimates of the longer-term neutral rate. So I would say monetary policy is restrictive, more so after today's decision, meaning that it is putting downward pressure on economic activity and inflation. We'll keep monetary policy restrictive until we think it's not appropriate to do so. So that's how I think about it. I mean, if I sum it up, I would say we've come a long way. We are resolutely committed to returning inflation to our 2% goal over time. Inflation has proved stronger than we and other forecasters have expected. And at some point that may change. We have to be ready to follow the data. And given how far we've come, we can afford to be a little patient as well as resolute as we let this unfold.
On the credit side, I'm wondering if you saw anything in the latest SLOOS data that made you think you're getting a quantum of credit contraction beyond what you'd expect. The bank lending data really is, the growth rates edging down towards and heading below zero, which is usually a recession indicator.
So I guess the SLOOS will come out early next week. And I would just say it's broadly consistent with what you would expect. You've got lending conditions tight and getting a little tighter. You've got weak demand, and it gives a picture of pretty tight credit conditions in the economy. I think it's really hard to tease out how much of that is from this source or that source. But I think what matters is the overall picture is of tight and tightening lending conditions, and that's what this SLOOS will say.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. Could you break down the reasons why inflation has fallen and what share of that credit you would give to factors that don't stem directly from rate hikes or that might be within your control at all, like easing supply chains and a drop in energy prices over the past year?
Yeah. So, interesting question. So let me start by saying that the inflation surge that we saw in the pandemic resulted from a collision of elevated demand and constrained supply, both of which followed from the unprecedented features of the pandemic and the response from fiscal and monetary policy. And we've always expected that the disinflationary process would stem from the normalization of those broad pandemic-related supply and demand conditions and from restrictive monetary policy, which would help return the balance between supply and demand by restraining demand. And we think that's broadly what we're seeing. So to go break it down a little further, of course, headline inflation has come down sharply from elevated levels as energy and food prices have come down, mostly due to reversal of the effects from the war in Ukraine. And that's a good thing, and the public experiences that, as I mentioned earlier. For core inflation, I'd say there has been a role for both factors, both that I mentioned. Clearly, for goods, normalization of supply conditions is playing an important role, as is the beginning of the reversal of spending back into services and away from goods. Take autos as an example. The combination of an increase in sales and inventories, while vehicle inflation has decelerated, points to a substantial role for supply. but there's also a role for demand as, the loans and things like that are more expensive. So they're both working there. Housing services inflation now starts to move down. Clearly, higher rates have slowed the housing market. I would say monetary policy is working about as we expect, and we think it'll play an important role going forward, in particular in non-housing services, where really we think that's where the labor market will come in as a very, very important factor. So we think both of those sources of disinflation are playing an important role.
And just to follow up, do you think that of those two sources, that core will rely more heavily on seeing an impact from rate hikes, or is there a more even split there too?
I think monetary policy is going to be important going forward, because we're sort of reaping now the benefits of the reversal of some of the very specific pandemic things. We're seeing that with goods in particular, with supply chains and shortages moving, and we're seeing. So I think going forward, monetary policy will be important, particularly in the sector, in the non-housing services sector.
Thank you, Chair Powell. First, let me compliment your tie, the choice of tie. So thanks for taking our question. So the Beige Book, it said, input cost pressures remain elevated for services firms, but eased notably for manufacturing sector. Is that an indication that there's a wage inflation pressure? And how do you target and pressure on the wage inflation without pushing the economy into recession?
Well, I think as it relates to goods, it's really an indication that supply chains and shortages are easing. And so what was the first part of it?
So wage inflation, like how do you target wage inflation without pushing an economy into a recession?
I don't think we're targeting wage inflation. I think what we're looking for is a broad cooling in labor market conditions, and that's what we're seeing. So wages have actually been gradually moving down. They're still at levels that would be consistent over a long period of time with 2% inflation. Nonetheless, we're making progress there. And by so many indicators, labor market demand is cooling. You can look at surveys by workers and businesses who see that. You can look at the quits rate normalizing. You can look at job openings coming down. You can look at just job creation in the establishment survey has, it's still at a high level, but it was at really an extraordinarily high level for most of the last 2 years. So you see cooling, particularly in private sector in the last in the last report. So I think we see that, and it's happening at a gradual pace. So that's actually not a bad thing in a sense, because if what we see is a labor market, very strong demand for labor, which is really the engine of the economy. People are getting hired, many people going back to work, getting wages, spending money, and that's really what's driving the economy. But that it's gradually slowing, it's gradually cooling. That's a good prescription for getting where we want to get.
But still, we see a push to raise minimum wage. We're seeing a lot of unions go on strike or threaten strike. And the common thing is they come out with agreements like big pay increases, like UPS, and we have the auto workers coming up. Are you concerned then about a trend of series of big unions, these contract pushing wage inflation then?
Not for us to comment on contract negotiations. Not our job, not our role. We monitor these things and we'll keep an eye on them. But really, that's something that's handled at that level. And not.
Hi, Victoria Guido with Politico. I wanted to ask about the SEP, which suggests that you would cut rates as overall and core PCE get to around or under 3%. And so I'm wondering, is the level of inflation what's sort of important there as you think about getting to 2% and when you might start cutting rates? Or is the speed at which inflation is falling also important?
I think you'd take both into account. I think you'd take everything into account when you start cutting rates. It would depend on a wide range of things. And when people are writing down rate cuts next year, it just is a sense that inflation is coming down and we're comfortable that it's coming down and it's time to start cutting rates. I think, but I mean, there's a lot of uncertainty between what happens, in the next meeting cycle, let alone the next year, let alone the year after that. So it's hard to say exactly what happens there, what's motivating people.
So if it's sort of stubbornly in maybe the high twos, you wouldn't necessarily cut rates.
I'm not saying that at all. I'm not giving you any numerical guidance around that. I'm saying we'd be comfortable cutting rates when we're comfortable cutting rates, and that won't be this year, I don't think. It would be, many people wrote down rate cuts for next year. I think the median was several. for next year, and that's just going to be a judgment that we have to make then, a full year from now, and it'll be about how confident we are that inflation is in fact coming down to our 2% goal.
A good part of Wall Street has become more confident that the Fed is going to be able to engineer a soft landing, and they've reduced their forecast for a recession. And I'm wondering if the staff has changed its view on the likelihood of a recession being likely, and if you personally have changed your view in terms of becoming more confident that you can achieve a soft landing.
So it has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my view. That's still my view, and I think that's sort of consistent with what I see today. So, but it's a long way from assured, and we have a lot left to go to see that happen. So the staff now has a noticeable slowdown in growth starting later this year in the forecast, but given the resilience of the economy recently, they are no longer forecasting a recession. I just want to note that that our staff produces its own forecast, which is independent of the forecast that we, as FOMC participants, produce. Having an independent staff forecast, as well as the individual participant forecast, is really a strength of our process. There's just a lot of, I think, constructive diversity of opinion that helps us make, informs our deliberations, helps us make, I hope, better decisions.
And is the reason for optimism that inflation has come down and you still have a strong labor market? I mean, does that add to the optimism?
I wouldn't use the term optimism about this yet. I would say, though, that there's a pathway. And yes, that's a good way to think about it. We've seen so far the beginnings of disinflation without any real costs in the labor market, and that's a really good thing. I would just also say the historical record suggests that there's very likely to be some softening in labor market conditions, and consistent with having a soft landing, you would have some softening in labor market conditions, and that's still likely as we go forward with this process. But it's a good thing to date that we haven't really seen that. We've seen softening through not through unemployment, not through higher unemployment. We've seen softening through job openings coming down part of the way back to more normal levels. The quits rate, so people are not quitting as much. We've seen participation, people coming in, and so labor supply has improved, which has lowered the temperature in the labor market, which was quite overheated, going back a year or so. So we're seeing that kind of cooling, and that's very healthy, and we hope it continues.
Thank you, Mr. Chairman. Jeff Cox from CNBC.com. You and other Fed officials in the past have suggested that you don't need to keep hiking until inflation hits 2%, that as long as you see continued progress. So I'm wondering, how close do you need to get with the inflation numbers coming down? How many months of data do you need to see that will give you sufficient confidence? And how far does this fight need to go before you're willing to kind of declare victory on it?
So the idea that we would keep hiking until inflation gets to 2%, it would be a prescription of going way past the target. That's clearly not the appropriate way to think about it. So. In effect, if you look at our forecasts, the median participant, and again, these are forecasting out years, so take them with a grain of salt, but people are cutting rates next year because the federal funds rate is at a restrictive level now. So if we see inflation coming down credibly, sustainably, then we don't need to be at a restrictive level anymore. We can move back to a neutral level, and then below a neutral level at a certain point. I think we of course would be very careful about that. We'd really want to be sure that inflation is coming down in a sustainable level. And it's hard to make. I'm not going to try to make a numerical assessment of when and where that would be, but that's the way I would think about it. Is you'd stop raising long before you got to 2% inflation, and you'd start cutting before you got to 2% inflation too, because we don't see ourselves getting to 2% inflation until, all the way back to 2 until 2025 or so. So.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. It's been over 4 months since a handful of regional banks, including Silicon Valley Bank, failed. When you look at credit conditions now, given Banc of California's acquisition of PacWest, does this acquisition suggest the full impact has not been felt, or are you comfortable saying that we've seen most of the ripple effects that may have occurred at this point? And how does this play into your outlook for policy?
So I don't want to comment on any particular merger proposal, but I will say things have settled down for sure out there. Deposit flows have stabilized, capital and liquidity remain strong. Aggregate bank lending was stable quarter over quarter and is up significantly year over year. Banking sector profits generally are coming in strong this quarter, and overall the banking system remains strong and resilient. Of course, we're still watching the situation carefully and monitoring conditions in the banking sector. In terms of the actual effect on, if you think of a particular set of banks that were affected because of their size and business model and things like that, that were more affected by the turmoil in March than others, it's very hard, as I mentioned, it's very hard to sort of tease out the effects on this very large economy of ours from them tightening. They may be tightening a little bit more, probably are, than other banks. The SLOOS has been telling us for more than a year that banking conditions are tightening. That process is ongoing, and that will restrain economic growth. So I think we have to take a step back from. I can't separate those anymore. I think basically we're just looking at the overall picture, which is one of tightening credit conditions, and that's going to restrain economic activity. It is restraining economic activity. So that's how I would look at it.
And how is that informing your outlook for setting policy?
So I think that is an expected result of tightening interest rate policy, is that bank credit conditions, bank lending conditions would tighten as well. And so the question is it more effective this time because of what happened in May? I just don't think we know that. I think we're looking at the current data in GDP, and we're seeing strong spending. We're seeing a strong economy, and it's made us confident that we can go ahead and raise interest rates now for the third time since the March events. It seems like the economy is weathering this well, but of course we're watching it carefully and expect to continue to do that.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I wondered on wages if you were at all concerned about any inflationary impact of wages now outpacing inflation, which is likely contributing to the boost in consumer sentiment and the continued strength of the consumer that we've been seeing.
Well, wages in excess of inflation means real wages are positive. Again, that's a great thing. Of course, we want that. We want people to have real wages, but we want wages to be going up at a level that's consistent with 2% inflation over time. As I mentioned, nominal wages have been coming down gradually, and that's what we want to see. We expect to see more of that. That's just more of what's consistent over a longer period of time. We don't really think that wages were an important cause of inflation in the first year or so of the outbreak, but I would say that wages are probably an important issue going forward. Labor market conditions broadly are going to be an important part of getting inflation back down, and that's why we think we need some further softening in labor market conditions.
This goes sort of to the balance of risks question, but you mentioned at the start how you're keeping an eye on consumer activity and whether there might be some sort of a rebound there. And I'm curious what the Fed's explanation would be to families if further interest rate hikes start to hit the labor market, start to drive that sentiment back down. What's the message there of why you continue to keep rates elevated or to raise them?
Well, we have a job assigned to us by Congress to get inflation under control. And we think the single most important thing we can do to benefit those very families, especially families at the lower end of the income spectrum, is to get inflation sustainably under control and restore price stability. We think that is the most important thing we can do now. and we're determined to do that. And I would just point out that the people who are the most hurt by inflation right away are people who are on a low fixed income, who, when you're talking about travel or transportation costs, heating costs, clothing, food, things like that, those, if you're just making it through each month on your paycheck and prices go up, you're in trouble right away. Even middle class people have some resources and can absorb inflation. The people in the lower end of the income spectrum have a harder time doing that. So we need to get this done, and the record is clear that if we take too long or if we don't succeed, that the pain will only be greater. So that's how I would explain what we're doing.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You had said last month that this meeting this week was going to be a live one. In the event the market had assigned a roughly 99% probability to the rate move that you announced today, the decision was, of course, unanimous, and the statement was basically unchanged from last month. So may I ask, to what extent was the meeting actually a live one? Was there ever any doubt over the past 2 days about what the decision was actually going to be?
Well, I mean, was there doubt? I would say there's a range of views on the committee, and when you see the minutes in 3 weeks, you'll see that. There's a range of views about what we should do at this meeting and what we should do at the next meeting, and it's a process that we go through. Many times when we go into a meeting, the decision is not, fundamentally in doubt. Nonetheless, we have the meeting, and some meetings are less uncertain than others, and I'll just leave it at that.
Evan Reiser, Market News International. Thank you, Chair Powell. Financial conditions have been loosening at a fairly steady clip in recent weeks, the dollar, the stock market, et cetera. What does that mean for the Fed in being sure that inflation will come down to target?
So we monitor, of course, financial conditions, broad financial conditions. You're right, it's the dollar and equities, and we're of course very focused on rates and our own policy. We're going to use our policy tools to working through financial conditions to get inflation under control. The implication is, we will do what it takes to get inflation down, and in principle, that could mean that if financial conditions get looser, we have to do more. But what tends to happen, though, is financial conditions get in and out of alignment with what we're doing, and ultimately, over time, we get where we need to go.
If I could also ask about the SEP from June that showed rate cuts. Do you expect the Fed to cut nominal rates next year while also continuing QT?
So that could happen. The question is, is that consistent with? So if you think about both of them as normalization, imagine it's a world where things are okay, and it's time to bring rates down from what are restrictive levels to more normal levels. Normalization in the case of the balance sheet would be to reduce QT, so to continue it. You depending on where you are in the cycle. So they're two independent things, and really the active tool of monetary policy is rates. But you can imagine circumstances in which it would be appropriate to have them working in what might be seen to be just different ways, but that wouldn't be the case.
Thanks, Chair Powell. Kyle Campbell with American Banker. I have a question about the discount window. I'm wondering if since the bank failures of the spring, if you've seen signs that banks have taken more steps to be proactive in assuring that they're ready to use that facility if they need to. And if you have any sort of thoughts on whether policies might be appropriate for making sure that banks sort of test regularly to show that they are prepared to use it. Thanks.
So that's a very important thing, yes, and yes to both sides of that. Yes, banks are now working to see that they are ready to use the discount window, and we are strongly encouraging them to do that, banks broadly. We did find, as you know, during the events of March, and that that it's a little clunkier. It can be a little clunkier and not as quick as it needs to be sometimes. So why not be in a situation where you're just much more ready in case you need to access the discount window?
Mr. Chairman, Mark Hamrick with Bankrate. You've talked in the past about getting the housing market back into better balance, excuse me, and also that the market might have bottomed. Where do you see that situation and balance, or lack thereof, right now, particularly with the constrained inventory of existing homes that might otherwise be coming onto market at a time when existing homeowners are reluctant to move? And of course, all of that happening with the 30-year fixed-rate mortgage still around 7% on the heels of Fed tightening, and with what you're talking about, tightening industry lending standards. Are we getting closer to balance or farther away? What's your sense?
I think we've got a ways to go to get back to balance, really for the reasons that you talked about. With existing homes, there are many people who have low-rate mortgages, and whereas they might want to sell in a normal situation, they're not going to because they have so much value in their mortgage, which means that supply of existing homes is really, really tight, which is keeping prices up. On the other hand, there's a lot of supply coming online now, and there are people coming in. A lot of the buyers are first-time buyers coming in at buying it with these relatively elevated mortgage rates. But I think this will take some time to work through. Hopefully more supply comes online, and we work through it. We're still living through the aftermath of the pandemic.
We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Russia has pulled out of an agreement allowing shipments of grain, safe passage through the Black Sea, and alternative routes at this point could be closed off. Just wondering, how could that contribute to higher food prices and inflation generally, and how closely are you watching that?
We are watching it, of course, very closely. And you're right, the withdrawal from the Black Sea Grain Initiative does raise concerns about global food security, particularly for poorer countries that import a large share of their food. Grain prices did go up on this news, but they remain well below their peaks of last spring. And the moves that we've seen so far, I would say, are not expected to make a significant contribution to U.S. inflation. Of course, we will be watching that situation carefully.
So you don't think it would have a big effect on Fed policy at this point?
You wouldn't say so, looking at what we know now.
Thank you.
Thanks very much.
That's a man who wants to get out of the room. Live from New York City this afternoon. Good afternoon. That was Chairman Powell down in Washington, D.C., wrapping up the Federal Reserve news conference following a 25 basis point hike. Alongside me, Tom Keene, Lisa Abramowitcz. I'm Jonathan Ferro. Special coverage of that decision just to work through the price action. Going through the news conference, initially a pop in the equity market, then it faded. I'll get to the why we got the fade in just a moment. The equity market right now is negative by 1/3%. Guidance for the next meeting. Make of this what you will. It's possible we'd raise or hold in September if the data warrants it. Are we restrictive? This far more interesting. The FOMC believes monetary policy is restrictive. Policy not restrictive enough for long enough, though. The real Fed funds rate is at a meaningfully positive level. On the economy, my base case is achieving 2% inflation without big job losses. He goes on to say the Fed staff no longer forecast a recession, but on CPI, Lisa, and this is when the equity market started to fade, I don't see inflation back at 2% until about 2025, so like way out in the distance.
This was Operation Say Nothing, where you basically repeat data dependent over and over again, but didn't say which data. And then you basically had a little bit for everybody, basically saying they are concerned about inflation, but recognizing that inflation has come in somewhat. This was Operation Do No Harm and say nothing and get out of there as quickly as possible, which he just did.
Highly repetitive, sometimes tedious.
Yes.
In the bond market, yields were higher going into this decision, lower following it. The two-year yield is down, Tom, by about 3 or 4 basis points in the bond market right now. TK, 483.91.
Some yield moves. It's good to see Gina Smilik of the New York Times pulling the Barbie movie here to give us the spirit of the American economy. January 31, 2024. Is he going to have a Lagarde-like press conference first of the year for the Fed, like tomorrow's Lagarde press conference if he gets a GDP slowdown, as we heard Bob Michael and Andrew Hollenhorst talk about? I'm fascinated about the luxury he has right now of a buoyant American economy, and if that drifts away, I'm not predicting that, but if that drifts away, John, is it Lagarde-like in January?
He is predicting it won't drift away.
Yes, very much.
The Fed staff are saying no recession in their forecast. Germany is living one. currently. On the balance of risks around the economy, take a listen to what the Fed chairman had to say.
It's really a question of how do you balance the two risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not. But as our stances become more restrictive and inflation moderates, we do increasingly face that risk.
If you asked that question 12 months ago, the answer was obvious. What's the biggest risk right now? Doing too much, doing too little? They would have told you straight off the bat. The biggest risk right now is doing too little. We need to hike 50, go even more than that. TK, the further along you get into this journey of Chairman Powell and co., the less obvious the answer to that becomes. And we're at that point right now.
We're post-pandemic without a theory. And if you're at Berkeley taking your PhD, maybe you can figure out a theory post-pandemic, but I don't see it. William Dudley joins us now. He's a former New York Fed president, has the immense advantages of years with Ed McKelvey doing market economics at Goldman Sachs. We're thrilled that Dr. Dudley could join us this morning. Bill, we got to wake everybody up after a summer press conference. You, ancient past, Bill, this is 20, 30 days ago. The great U.S. Treasury bond rout is far from over. What I have not heard today is a discussion about higher interest rates. What is your belief that we could see higher interest rates?
Well, I think the Chair Powell made it very clear in the press conference that he doesn't see the need to go that much further. The very fact that it's sort of meeting now tells you that he thinks that, maybe there's one more rate hike, maybe there's no more rate hikes as we go forward. But that's a very different story than what does that mean for the bond market? Because bond yields are low relative to short-term interest rates. I think there's a number of reasons why bond yields could move higher. Number one, inflation is probably not going to average 2% over the next 10 years. It's probably going to average a bit higher because the Fed has an asymmetric regime where when they miss inflation to the downside, they try to offset that with misses to the upside, but not the other way around. Also, if you look at the savings investment balance, it's not as favorable now as it was before because we have a lot more investment programs motivated by Biden administration policies. And the savings pool is also affected by the very large fiscal imbalances that the U.S. is likely to run for many, many, many years. So that implies that perhaps the neutral federal funds rate consistent with neutral monetary policy, a little bit higher than in the past. And then lastly, the risks are two-sided now for the bond market. Before it was all about, I could hold bonds, and if we ended up in a recession and the Fed got stuck at the zero lower bound, the bond market would protect me. But now we're a long way from the zero lower bound. So the risk of getting stuck at the zero lower bound seems very diminished at this point. And the risk of inflation being sticky, I think, remains very relevant to the bond market.
Bill, we had an article at Bloomberg this week, folks. John Authers and Isabel Lee reported on the strategy world and how absolutely it's brutal has been for Wall Street strategists. Bill Dudley lived this at Goldman Sachs years ago. How clear is the Dudley crystal ball right now, Bill? What's the vision you've got? Are you making it up as you go?
Well, I'm a lot less clear now than I was, say, a year and a half ago. I mean, at that point, it was very clear that the Fed was way behind the curve in terms of the need to tighten monetary policy. They were going to have to go to restrictive, and they were going to have to move fast to get there to keep inflation from getting totally out of control. Now they're at a restrictive setting, and so the question is, how high do they have to go to be sufficiently restrictive, and how long do they have to stay there? And I think they've been the economic news has been breaking in a favorable direction in the sense that they're getting quite a bit of disinflation without actually affecting the growth rate very much, or without actually putting a lot of people out of work. I mean, the fact that inflation's come down and the unemployment rate's still 3.6% is really good news from the Fed's perspective. But my own view is, I'm still where I was before. I think the Fed's going to have to be, tighter for longer, and I think they're going to probably emphasize the longer piece. If you look at their forecasts, they don't see inflation getting back to 2% until 2025. So they think the process still has a long way to go, and I agree with them.
Bill, how important do you think it is that essentially this is a Fed no longer giving forward guidance?
Well, I think that's sort of appropriate. If you've gotten in the vicinity of where you think you need to be, and you're uncertain about what's next because you don't know if you've done enough, you don't know much about the long and variable lags of monetary policy, you don't know how financial conditions are going to react to what you say and what you do. I think at that point you don't really want to give forward guidance because the forward guidance is probably going to be misleading as opposed to illuminating. So I think it makes sense for them to talk about going meeting to meeting. The only thing I was a little surprised today was that there wasn't much talk about the long and variable lags of monetary policy and the need to slow down the tightening, the rate of the tightening process. Powell very clearly put the September meeting back on the table. And I was a little surprised by that because the last meeting was all about the need to slow down and go at a slower pace. And now I find out today that September is a live meeting.
Well, and he was actually pretty blunt on that. Someone asked him specifically, how does this jibe with what you said at the previous meeting? And he basically was like, that's all I'm going to say about that. I'm not going to continue. I'm wondering whether you think it's actually more confusing that there wasn't dissent at a time where there clearly is a range of opinions, and we have a Fed chair just reading the same thing over and over again in response to everyone's questions.
Well, the lack of dissent just means that people are pretty comfortable with the general trajectory of where monetary policy is today, and they're happy about the fact that inflation is coming down, and they're happy about the fact that it's coming down without actually having to really push up the unemployment rate a lot, at least at this point. I think what's the problem that Powell has created for himself is what do you actually do in September? So in September, you're going to have a couple things. If you decide not to hike, what are you going to show in the summary of economic projection? Are you going to show further rate hikes? If you do show further rate hikes, it's going to raise the question of what thing you do in September, just like what we saw at the last meeting. And if you do hike, then the question is, okay, well, why are you going so much quicker now? And do you show further rate hikes in the summary of economic projections after a September rate hike? So I think he's made it very awkward for himself in terms of tying the projections of what's going to happen in the future to what they actually decide to do in September or decide not to do in September in terms of keeping rates unchanged.
But
so
I
think they've created a bit of confusion. I think it would have been better to stick to the story of monetary policy, long and variable lags. At this point, we're close to where we think we need to be. Therefore, we're going to go more slowly. But he definitely put September back on the table. I mean, he basically talked about the fact that we have 2 more employment reports until September. We have 2 more CPI reports before September. So he put the September meeting back on the table more than I would have thought he would have done, given that he talked about the need to go more slowly because of long and variable lags. So I found that a little bit confusing.
Are some people frustrated about this September conversation? Bill, I tried to jump in to end it, but we can carry it on if you want. Barry Knapp wrote in and he said this: questions about whether they hike in September were inane. He went on to say the press conference went poorly, given no questions about fiscal policy working at cross purposes with monetary policy, nor any questions about the deep curve inversion and impact on small banks and the supply of credit. Bill, can we pick up on the first piece just briefly? Whether fiscal policy right now is working at cross purposes with monetary policy. Do you think it is?
Well, I don't think fiscal policy is stimulative right now in the sense of the fiscal impulse. But we have very large chronic budget deficits, and those budget deficits are going to continue as far as the eye can see. So the way that plays out is it means that the demand on the pool of savings is higher because the government is taking down so much of the supply of savings. And over the next year, we're going to see a lot more Treasury supply, right? Now that the debt limit crisis is behind us, the Treasury is going to be ramping up their borrowing needs very, very substantially. And the Federal Reserve is going to continue to sell. Is going to continue to let $900 billion a year of treasuries and mortgage securities throughout. So they've made tremendous amount of supply, and I think that's going to weigh on the bond market a bit.
Bill, the hallmark of your work at Goldman Sachs ages ago was an optimism about the American economics experiment. The most memorable moment today was Janice Smialek of the New York Times folding in the Barbie movie into a discussion with the chairman of the Federal Reserve about the resiliency of the American economy. To smart guys like you, everybody assembled in the room, everybody in the economics racket, do we just get wrong the resiliency of America?
Well, I think that we have gotten wrong the resiliency of the U.S. consumer. And I think what's driving it is the fact that during the pandemic, there were large fiscal transfers from the federal government to the household sector. And the household sector basically did 3 things with it. About a third of it was spent, about a third of it was used to pay down debt, and about a third of it was saved. And so coming out of the pandemic, the household balance sheets were in much better shape than they typically are late in the cycle. And I think that's why the U.S. consumer has been pretty resilient. I mean, I think the point that Gina was making was just that, going to Barbie in a theater is a perfect example of discretionary discretionary consumption. People can decide to do that or not decide to do it. It's not sort of a core necessity. And so the fact that the box office for Barbie and Oppenheimer were so good was sort of evidence from her perspective that the consumer has still got some life in them.
That's a surveillance movie review right there. You got to ask him, did he go? You got to ask him.
Getting Bill Dudley and on Barbie. Tom, if you want to know, you can find out. Bill, did you watch it over the weekend?
No, I went to Mission Impossible. I haven't gone to Barbie or Oppenheimer. That's on my plans, though.
That's in the pipeline.
There we go.
Discretionary spend.
We just learned more there than we did in the press conference.
In the next weekend. Bill, thank you, sir. As always, Bill Dudley, incredibly insightful, lived it at the Federal Reserve as the New York Fed president. If you are just tuning in, welcome to the program this afternoon. Good afternoon to you all. The Federal Reserve hiking interest rates 25 basis points. The Federal Reserve chair saying that he believes monetary policy is restrictive. There was a moment in this news conference when Mike McKee, our good friend and colleague down in Washington, D.C., asked about that. I'm pleased to say that Mike McKee joined us now. Mike, the evidence that policy is restrictive, can you point to it?
Well, he's pointing to the fact that inflation has come down and that the Fed funds rate is now above the CPI in all cases, in both core and headline, and that real interest rates are starting to rise above zero. So they do see some restriction on the economy. But I think one of the key things he said was in his answer to me when he said policy has not been restrictive enough long enough. Now, he doesn't want to put a time frame or a actual number on what restrictive is, but clearly they could be there. They just have to leave it there longer. This was a man who wanted to basically keep his options open and not get tied down to anything at this point.
Mike, what does this 25 basis point move do to our listeners and viewers? I get, and this was alluded to by a number of our guests, big impact a year ago, 2 years ago. What's the impact today of this lift for housing, for food, for the day-to-day life that we have?
Well, it's probably not going to have much of an impact overall in a 25 basis point sense. It's the cumulative amount of tightening that's been done. That's what Jay Powell has been referring to over the last year and a half, where they've gone 550 basis points. Now, what you're looking at is decisions made on interest rates over a period of time. You don't buy a house every day. You don't buy a car every day. You don't spend money investing in a new factory every day. So it does take time for that to work its way into the economy. They don't know how restrictive they have to be. Clearly, they haven't been restrictive enough in the housing sense because home prices have still been rising. But overall, they're getting close to that area. And I don't think that the average American is going to notice really anything different about this 25 basis point move.
Mike, every time the Fed has a meeting, you sit there, you listen to the tenor, the potential snafus, the way that people ask questions. Today you heard a very repetitive, very stick to the script, Jay Powell. There was no forward guidance. When was the last time this Federal Reserve gave no forward guidance about what they were planning to do or how they even were thinking about the data that's coming in?
Well, it's been quite some time. The idea today, and I said this before the meeting, was that come in, make as little news as possible. They were locked into raising rates because the market had decided that's what they were going to do. And so the Fed went ahead and did that. And beyond that, they tried basically to leave their options open. Jay Powell was very scripted, as you heard. He did sound more relaxed than he did at the last meeting or the last couple of meetings. So from that standpoint, Lisa, you could say maybe the vibe was they're getting close to the end. And I'm not sure at this point that they would raise rates again. But they don't want the markets to walk away from this thinking that they're going to do one thing or another. So they tried not to really give any guidance.
We're covering vibes of news conferences now with Mike McKee. Mike, thank you, sir, down in Washington, D.C. Appreciate it, as always. Here's the runway, the calendar for you. September 20th. The next Federal Reserve decision. Jackson Hole, of course, in between this meeting and the next meeting. For the data, August 4th for payrolls, August 10th for CPI, September 1st for payrolls, September 13th for CPI. So TK, 2 of each, CPI and payrolls, going into the next Fed meeting. And you can take away from this meeting, this news conference, whatever you want. That conversation can change very quickly based on 2 prints of CPI and 2 prints from payrolls.
Elisa nailed it. She said it's just completely data dependent. I'm going back to that. I don't think there's any theory involved here. I don't think there's any textbooks. That conversation we had before the press conference was just absolutely brilliant on the ambiguities of the moment. Right now, with clarity, because he has to manage money, Jeffrey Rosenberg joins us, portfolio manager of BlackRock's systematic multi-strategy fund. Jeff, my deepest sympathies. You have to have a conviction, a belief forward. What is your conviction now, given the ambiguities we witnessed today? I think we have a little bit of silence here.
They're going to turn his microphone up, TK.
There.
You know,
I don't, you know.
Jeff put it on mute.
They're on mute.
Jeff's got to unmute himself.
But
It's
the
like a Zoom call
ambiguities
gone
here,
bad.
you know, the ambiguities here are important. And John,
Bram, you know that's like when you're in the team meeting and Lisa starts throwing stuff at the screen. It's like, Bram, you're on mute.
I'm going away tomorrow.
Listen to me.
You know,
And I start like pounding, and then excuse me.
I'm going away
Pass the tea.
tomorrow. And you
Where
guys are
are you
running
going?
the show. I'm going deep to the Northeast. I'm just going. It's just going to be. I'm going away for months. It's going to be like a sabbatical.
You're taking
like
a month
you
off.
Taking a month off.
That means 2 days.
Yeah, and you guys have the former vice chairman of the Fed, and the arch question to Vice Chairman Clarett, I believe, scheduled tomorrow in Bloomberg Surveillance in the morning. Check it out, folks. And I'm John. I'm sorry. The arch question here is Clarett saying we're not going back to 2%. We're not going back to 2%. Nobody, and Powell's not talking about it. I don't think anybody else really is. Clarett is out front on that.
I'm with you. The standout call from former Vice Chair Rich Clarett together with PIMCO came out in the Secular Outlook a couple of months ago. And ultimately, it's this underlying belief that they will tolerate higher, above target inflation of 2 point something. You got some indication of that, just a hint of it, when he talks about we're not going to hike until we get to 2%. That's ridiculous. And also, by the way, we don't think we're going to get to 2% until 2025. And within that, I think there is a message, Bramo, that they are willing to tolerate 2 point something because they're willing to tolerate above target inflation from here all the way out to 2025 if the Fed chair's correct.
You pick up a really interesting point because it highlights the uncertainty around long and variable lags. He's saying that if we wait until inflation gets down to 2%, we will have necessarily gone too far. Okay, well then how long do you have to wait before you understand what the ramifications of what you hiked? Is this a concession that you're willing to go to 2.5%? And that is really what people are trying to parse through. Basically, people are shrugging off, viewing this as a non-meeting. That's my view.
We haven't talked about this enough, though, and I think Jean Barvan of BlackRock, congratulations, by the way, for bringing this up repeatedly. What's the appropriate time horizon, the appropriate period to bring inflation back towards 2%? What is it? So one man's tolerance of above target inflation is another man saying, well, actually, we just need longer. And if he says 2025, isn't that just him saying, like, this is going to take a while and I don't want to crush the economy to get there sooner?
Well, I think that that's a great point. And I think the Fed said that they're willing to be patient but persistent. At that point, the issue is, will it become a self-fulfilling prophecy at some point?
Exactly.
If inflation becomes
Is there a
higher?
window? That's what you're getting at.
Yes, thank you. I appreciate that. That's helpful.
Well, it's a long day. I feel the way, you can fill in my sentences. You can fill in my sentences as well. I need it sometimes too, Bramo. Is there a window where they need to address this before it becomes embedded?
Right.
You've seen what happened with UPS and what almost happened with Teamsters and the strikes. What are we talking about here? 5% wage hikes? They're not going to be alone, are they?
No, and we're already seeing that pretty much across the board. And people talk about the tight labor market, but that changes the scenario in this profound way. This is the issue that a lot of people are looking at. And yet you're seeing that divide, whether it's Bob Michael or whether it's Jim Bianco.
You see the divide, and the wage thing is critical because a lot of people, they don't parse out unemployment rate. They don't parse out this, that, and the other thing. They are only and singularly looking at wage inflation. Through all this debate, if folks say, what's this meeting like versus the other 10 meetings we had? And I'm going to go to the great observation of Neil Dutta that we finally have a legitimate real wage in this country. And that changes the emotion, the behavior of people, like the bombshell from Drew Mattis earlier this week, really pushing against the gloom we heard from our guest, where he says you got a legitimate real GDP forward. Part of that, John, is a legitimate wage growth, which I don't think is within the debate right now. Inflation worry. We're worried.
Inflation worry.
We're worried.
I'm not worried if I'm getting a pay rise. I let other people worry about that. I think, I've always found it weird when economists say, this is uncomfortable. Wages are too high. And everyone else is just like, there's nothing uncomfortable about this. That's what I want to happen at year end. I want a pay rise.
And we heard Jay Powell really speak to that. Yeah. He basically said, we want this. It's a good thing that wages are going up faster than inflation. And yet, is it, if that's the goal, to get down to 2%? This is a conundrum. And he tried to parse it through by absolutely saying nothing.
Elisa, you and I will try and say something tomorrow morning. We'll be here alone without TK. I think tomorrow there's going to be a conversation about something Mike McKee talked about in the news conference. What's restrictive? And what evidence is there that we are restrictive right now? This is what the chairman said. The FOMC believes monetary policy is restrictive. He did acknowledge that it's not restrictive enough for long enough, so they need to hold it here for some time. But ultimately, if you look at the real Fed funds rate, it's at a meaningfully positive level. OK, well, let's look around. What evidence is there of that right now? And I would go one step further. What evidence is there that the disinflation we have seen so far is a consequence of the tightening they've delivered if they believe there are these exceptionally long and variable lags? And I would go to what Neil Dutta said at Renmac during this news conference, and I'll read out what he sent to me privately, but he's happy for me to share it with you all. He said the Fed remains wedded to the long and variable lags hypothesis. After 18 months, we've seen home prices accelerate, stock prices accelerate, auto sales accelerate, and layoffs sink. Long and variable lags is a concept that might be outliving its usefulness. Now, for the same people looking at the same evidence, you can have one individual, Brammer, that turns around to you and says, I think the long and variable lags are a whole lot longer. And someone else can make a different case with the same data and say, you know what, I think they're a whole lot shorter. They just haven't had any effect yet.
And anyone who's looking to the Fed for guidance, forget about it, because they're not going to give you any. And basically what I heard was a chair moving the goalposts, saying, OK, it might be restrictive, but it hasn't been restrictive for long enough. So is this a new criteria that it has to be long enough, that you put that x-axis long enough, and then that will take place? They don't know. So how do they communicate? We don't know. We're experimenting. We're going to look at things.
I think out of this conversation, and this is Ed Hyman, Evercore ISI, and I thought Michael Darda of Roth MKM was just brilliant today on this. There's an entire monetary or money side to this, including something no one talks about anymore, which is M2. I mean, if I was down there with Powell asking a question, I'd say to Chairman, your PhDs tell you at the Fed that M2 doesn't matter anymore, velocity doesn't matter. Europe just announced a crater in loan demand with a slowdown there as well. What's the viscosity right now of the American system? Bob Michael's here. I saw him. He's on his phone doing commercial real estate workouts for Jamie Dimon while he's sitting on set in commercial.
Don't start rumours.
Good morning, Bob. Thanks for being with us.
Bob was fantastic, by the way.
Yeah.
You've teed up Europe quite nicely because
I'm trying.
We shift away from the Federal Reserve.
Maybe I should cancel my trip
to cover the ECB.
It's a sabbatical, but Madame Lagarde would like me to be here.
The European Central Bank decision is tomorrow, and it's worth repeating that Germany is in recession. The data is absolutely dreadful, and inflation, Lisa, is still sticky.
And this is the fear. What happens if this ends up being a similar story in the U.S. if inflation reaccelerates and growth slows down? We didn't hear that from Fed Chair Jay Powell. His base case is we avoid a recession and we end up bringing down inflation to 2%. The Goldilocks, he's leaning into that. And yet, yes.
I don't think he's leading into Goldilocks. I think he's worried about Bill Dudley's outlook.
Right.
He's just. They don't want to make a mistake on the upside. They do not want to cut before they're certain. That's the emotion of the discussion.
I asked the question, Tom, earlier, whether the biggest risk right now was cutting too soon or holding too long. And I think
John,
I'm with you.
The biggest risk, if I miss the damn Gulfstream at Teterboro...
Never mind. I saw him checking the train times.
Yeah. Well, I think
during the news conference.
I think Jay Powell was checking the train schedule at the same time.
He wanted out too.
Yes.
We need out as well. You probably want rid of us. We'll see you tomorrow morning. TK will be gone. Thank you very much for choosing Bloomberg TV and Bloomberg Radio for your Fed coverage. From New York, good afternoon.